Hi, this is Brandon Bischoff with Canterbury Investment Management, and we're just doing a brief market and portfolio update through the events of the first 2.5, 3 months of this year. And as you recall, we released a video last year going over the events that took place in 2020, and we talked about how the NASDAQ and these technology-related stocks really carried the markets last year. And so I'm going to refer back to this video. Take a look at this clip.
In this particular case, it was all about technology related stocks. I mean, a lot of these other sectors in the market, basic materials, energy, utilities, there's 10 sectors that make up the market. They had further corrections. A lot of those didn't come back very quickly. But technology has been so strong that it makes up a large component of the S&P 500. So what's happened is technology has taken off to the point where it's actually created a bubble. And that bubble is not burst yet. And if it weren't for technology, you wouldn't have had that good of a year last year. Technology rubber band, the market itself has been stretched. And we know that there's been a lot of bad news. And we know that, over the last 10 years, technology is up like 900%. That eventually we're going to see that burst of the bubble called technology, and that will have a real negative effect on the indexes.
So in that video, we talked about technology being in a bubble because of the substantial increase that it's experienced over the last, really past decade. But, we're not saying that technology's bubble is beginning to burst right now. But what we are seeing is that there has been significant rotations in the market. Before and last year, technology was the leader. It's been the leader for the last several years. It's been the top sector to own is technology stocks and technology-related stocks. But today, that's not necessarily the case. We're seeing other sectors sort of take a forefront in leadership. So let's look at these tables. Here's a ranking of the S&P 500 sectors according to our Canterbury risk-adjusted ranks, which account for each sector's volatility as well as its relative strength. And what we can see going back to February the 1st, we can see that the rankings were heavily dominated by these technology-related indexes. Consumer discretionary contains Tesla and Amazon, and then you have a bunch of technology stocks like Apple and Microsoft, Nvidia, Netflix, and this technology sector. Now the S&P 500 is actually 40% technology. And as a result, on February the 1st, the S&P ranked second on this list because of its weight towards discretionary and its weight towards technology and these technology-related stocks. Fast forward a month and a half and things look a little bit different. We can see that discretionary and technology have both fallen significantly down the list. They've fallen down to 7 and 6 because of this rotation that we've seen in the markets. Since the S&P 500 is 40% in those technology-related stocks, you can see that it is now in the middle of the list. Even more surprisingly, energy, which has consistently been ranked in the bottom of the list, has actually risen 8 spots during this rotation and is now the second best sector to be invested in. So in summary, you've gotten a significant rotation. The S&P 500 is now kind of being pulled down by these technology-related stocks that had previously helped it in the past. So one thing that's becoming clear is that the market environment is changing. Sectors are rotating and they're rotating very fast. Volatility is beginning to pick up within the markets, and we expect that those sector rotations will continue. And this is the kind of market environment that the Canterbury portfolio thermostat and adaptive portfolio strategy is really geared for, because we can adjust our holdings and we can adjust our allocations to match the new existing market environment. So I'm going to bring in Tom Harden. He's going to talk a little bit more about the Canterbury portfolio thermostat and show some charts of some of the holdings that we've held and some of the rotations that we've made to start this year.
As Brandon said, we're beginning to see some rotation among the major market indexes. In particular, we're beginning to see the NASDAQ, the big tech companies, begin to underperform. And if you look at the green line, starting with the number 1, where it shows peak, you can see that the NASDAQ has declined about 11% beginning in mid-February, and then it's had a little bit of a rebound. That's impacted the blue line, which is the S&P 500, And the Canterbury portfolio was already rotated into some of the newer sectors that are now beginning to outperform. And you can see the substantial outperformance of our portfolios. So as I mentioned, the Canterbury portfolio has been substantially outperforming this year. And the question is, how's that happening? Well, first we know that the NASDAQ, which has been carrying the market for quite some time, has now lost a lot of momentum, has had a correction. And if we go back to about February the 9th, the NASDAQ is off about 4.5%. Compare that to a couple industries that we picked up on February the 9th, which were oil and gas exploration and copper. Those are up 20 and 13% respectively. So this is a good example of how some of the former weaker sectors of the market have come to the fore, while the strongest sector, NASDAQ, has begun to fall off. Typically, portfolio managers will own bonds to reduce risk. Bonds are considered to be conservative, but sometimes we forget that bonds have bear markets as well. And if we go back to October the 20th, we had a sell on bonds, so we bought the inverse treasury bond. The inverse treasury bond moves in the opposite direction of the 20-year treasury. So from that time through now, the treasury bond has dropped 14%, while the inverse treasury bond has gone up 14.8%. So again, instead of being down 14%, we're able to be up 14%, and that directly contributed to the Canterbury outperformance year to date.
You know, as Bob Dylan says, the times they are a-changing. And I think it's safe to say that the market environments are also changing. And in this type of environment, it's crucial to be able to move quickly and to be able to adapt to that new existing market environment. And that's why we utilize a tool like the Canterbury Portfolio Thermostat to effectively navigate those changing market environments. So that brings us to the conclusion of this short video. We will keep you posted as market environments begin to change and new events begin to unfold. Thanks for watching and have a great rest of your week.